Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Beone Medicines Ag annual report. Beone Medicines Ag is a leading oncology company that specializes in the discovery and development of innovative treatments for cancer patients worldwide. The company's portfolio includes various commercial stage products that cater to different types of cancers. The company's commercial stage products include BRUKINSA, TEVIMBRA, SYLVNT, BA8UOWEI, and PARTRUVIX, which are used to treat various blood cancers and solid tumors. These treatments have been approved for use in the United States, China, Europe, and other international markets. In addition to its commercial stage products, Beone Medicines AG has a robust pipeline of clinical stage products that are currently undergoing testing. These include Sonrotoclax BG-11417, BG-16673, BG-60366, BG-89894, SYH2039, and several others that target specific cancer-related pathways. The company also has various preclinical programs in place, which aim to identify new targets for cancer treatment. Furthermore, Beone Medicines AG has established partnerships with leading pharmaceutical companies such as Amgen, BMS, Biothera, EUSA Pharma, Louis Pharmaceutical, and Novartis. Overall, Beone Medicines AG is a prominent player in the oncology industry, with a diverse portfolio of treatments and a strong pipeline of innovative products. Beone Medicines AG market capitalization of $261 billion is significantly larger than the average industry peer of roughly $16 billion. This shows that Beone Medicines AG holds a significant advantage in their industry. Beone Medicines AG trades at a higher price-to-earnings ratio of 118 times and a lower price-to-book ratio of 0.57 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The company maintains a moderate leverage profile, with liabilities making up 47% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth for a company can be attributed to several key factors. Firstly, an increase in product revenue by approximately 39.8% to $5.3 billion is a significant contributor to revenue growth. Additionally, royalty revenue has seen a substantial boost due to the commercialization of certain products such as XGVA, KYPROLIS, and BLINCYTO. The introduction of new products also plays a crucial role in driving revenue growth. For instance, BRUKINSA saw a 48.4% increase in sales, while TEVIMBRA experienced an 18.8% rise. Furthermore, the upfront payment of $885 million for IMDLLTRA and potential future royalties on annual ex-China net revenue are expected to contribute significantly to revenue growth. On the other hand, the primary drivers of revenue decline can be attributed to a combination of factors. Decreased sales of POB-VCY by 11.4% and a decrease in other product revenues by 12.9% have contributed to the decline in revenue from certain products. Period costs related to repositioning manufacturing capacity also played a role, amounting to $33.9 million. In conclusion, revenue growth is driven by a combination of factors including increased product revenue, royalty revenue, and the introduction of new products. Conversely, revenue decline can be attributed to decreased sales of specific products and period costs associated with repositioning manufacturing capacity. The net income of a company underwent significant changes over a period of time. Initially, it increased by approximately $931.7 million, indicating a substantial improvement from its previous state. This upward trend continued as the company transitioned from a loss of $644.8 million to a profit of $286.9 million. However, there was a slight decrease in net income by $357,853 from 2024 to 2025. The profit margins also showed an improvement over time. The shift from a net loss to a net income indicates a positive change in the company's financial performance. This improvement can be attributed to the increase in total revenues and the decrease in research and development expenses. Furthermore, the profit margin increased by 20.1%, rising from -11.7% to 8.4%. These changes suggest that the company has made significant strides in improving its financial health and profitability. But the company's financial performance indicates a significant improvement in its ability to generate positive cash flow from operating activities. In 2024, the company experienced a negative operating cash flow of $140,631, but this trend reversed in 2025 with a substantial increase of $1,127,580. This upward shift is also reflected in the net cash provided by operating activities, which reached $1.1 billion in 2025, marking a notable improvement from the previous year. The data suggests that the company has successfully turned its financial performance around, generating a significant positive operating cash flow in 2025. The increase of $1.3 billion in cash flows from operations compared to the previous year further underscores this trend. This positive development is likely to have a favorable impact on the company's overall financial health and stability. The company's debt level has undergone significant changes over the past year. While total debt decreased by 36.6% from $2,066,434 to $138,307, long-term debt increased substantially, rising by 477% from $166,484 to $961,913. This increase in long-term debt is a notable shift, as it suggests that the company may be taking on more substantial and longer-term financial obligations. In terms of interest expenses, there appears to be conflicting information. On one hand, interest expense decreased by 36.6% from 2024 to 2025, which could indicate a reduction in the company's debt burden. However, interest expenses also increased by 167.1% from $21,805 in 2024 to $58,234 in 2025, suggesting that the company is paying more in interest costs despite the decrease in total debt. This increase in interest expenses may be due to the significant rise in long-term debt, which could be contributing to higher interest payments. Overall, while the company's total debt has decreased, the increase in long-term debt and corresponding interest expenses suggests a shift towards taking on more substantial financial obligations. Management's outlook for the company is one of continued growth and expansion. Key highlights include reaching total global revenues of US $5.3 billion by 2025, with Beone SA generating US $3.9 billion in revenue that same year. The company aims to create impactful medicines that are affordable and accessible worldwide through its vision. To achieve this goal, the company has built a superhighway for global development to improve R&D returns and accelerate time to clinical proof of concept. This includes expanding leadership in hematology through lifecycle management of Beone SA and growing its pipeline with new treatments such as sonrotoclax and BTK-CDAC. The company is also investing heavily in commercial expansion, particularly in the US and Europe, as well as building capabilities in key markets like Asia-Pacific, Latin America, and the Middle East. This includes ongoing submissions and approvals for TEVIMBRA, delivering innovative therapies to patients worldwide, and growing revenue significantly beyond 2026. Overall, management strategy is focused on expanding globally, investing in research and clinical trials, and delivering impactful medicines to patients worldwide. The company's financial strategy has been focused on growth rather than distribution of profits to shareholders. One key aspect of this approach is the decision not to pay dividends, which means that investors have not received any direct returns in the form of cash payments. Additionally, the company has also chosen not to buy back its own shares, indicating a preference for investing in the business itself rather than reducing the number of outstanding shares. This strategy suggests that management is prioritizing long-term growth and expansion over short-term gains or shareholder rewards. There are concerns about inventory buildup in the industry. The data shows a significant increase in raw materials, with a 36.6% rise from 2024 to 2025. This suggests that companies may be stockpiling more materials than needed, which can lead to inefficiencies and waste. On the other hand, finished goods have decreased by 6.1% over the same period, indicating that production levels may not be keeping pace with inventory growth. This discrepancy raises questions about the industry's ability to manage its inventory effectively. If raw materials are being stockpiled at a faster rate than finished goods are being produced, it could lead to supply chain disruptions in the future. However, based on the provided summaries, there is no clear indication of immediate supply chain disruption concerns. That concludes the financial summary for Beone Medicines Ag. Feel free to comment below, and I will be happy to answer them when possible.